Introduction. Gold has always been a symbol of wealth and a safe haven asset. For centuries, it has been used to store value and preserve wealth during periods of political instability, economic uncertainty, and inflation. But how do elections, particularly in the United States, affect gold prices? And what can we learn from past election cycles? In this piece, we'll explore how US elections influence gold prices and why political events, especially presidential elections, have such a profound impact on market behaviour. US elections and gold, a historical perspective. The link between US elections and gold prices isn't purely coincidental. Shifts in monetary and fiscal policies, triggered by electoral outcomes, can lead to significant changes in gold demand. Additionally, political tensions and global events often make gold an attractive investment, especially when investor sentiment leans towards caution. Let's take a look at how different US presidencies have impacted gold prices. The Jemmy Carter era, 1977 to 1981. During the late 1970s, gold prices surged dramatically, increasing by 326%. This unprecedented rise was largely due to inflation, which reached double-digit levels, and global events such as the Soviet-Afghan War and the Iran hostage crisis. President Jimmy Carter's administration faced numerous challenges, from soaring inflation to oil crises, which weakened the US dollar and led investors to seek gold as a hedge against economic instability. As political tensions escalated, so did the appeal of gold. The Reagan years, 1981 to 1989. In contrast, under President Ronald Reagan, gold prices fell by about 26%. The Reagan administration, with its focus on tax cuts and reducing inflation through supply-side economics, sparked a period of economic recovery. The easing of tensions with the Soviet Union also contributed to a more stable geopolitical environment. As confidence in the economy grew, investors turned away from gold, driving its price down. Gold, traditionally seen as a hedge against uncertainty, lost some of its appeal as the market regained optimism. Barack Obama, 2009 to 2017, fast forward to the Obama administration, a time when gold prices experienced significant growth. Gold prices rose by 40% during Obama's presidency, peaking in 2011. The catalyst? The 2008 financial crisis and the subsequent recession. Gold gained traction as a safe haven investment due to concerns about the US debt ceiling and the potential for default. The global economy was in turmoil, and investors turned to gold to protect their wealth from the volatility in the stock market. The surge was also fueled by broader economic factors, such as central bank policies, interest rates, and geopolitical uncertainty. Donald Trump, 2017 to 2021. Under President Donald Trump, gold prices saw a rise again, particularly during his second term. The COVID-19 pandemic, coupled with ongoing geopolitical tensions, such as the US-China trade war, pushed gold to new heights. In 2020, gold hit over $2,000 per ounce for the first time, as investors flocked to the metal in response to the pandemic-induced economic downturn and uncertainty. Despite initial market optimism following Trump's election victory in 2016, it became clear that global events and crises would drive gold's resurgence. Midterm elections, a turning point. Midterm elections in the US also seem to influence gold prices. Historically, gold tends to rise post-midterms in about 62% of cases. This could be attributed to uncertainty around the balance of power in Congress and shifts in fiscal policies that follow such elections. However, recent trends suggest that other factors, such as the strength of the US dollar, global economic conditions, and broader market trends, are equally significant in shaping gold's performance. The shift post-2024 US election. Following former President Trump's projected win in the 2024 US presidential election, the immediate impact on gold prices was negative. Gold futures fell by approximately 3%, and the price of gold dropped from a recent high of $2,805 per ounce to around $2,673. But why did this happen? The answer lies in the market's anticipation of Trump's policies. Concerns over inflationary policies, massive deficit spending, and fiscal uncertainty, coupled with the political climate, led to rising bond yields and a strengthening of the US dollar. These factors made gold, which offers no yield, less attractive. Bond yields increased, and the 10-year US Treasury yield rose to a 4-month high, further adding pressure to gold prices. Gold and the US dollar, a delicate balance. Gold and the US dollar share a negative correlation. When the dollar strengthens, gold prices tend to fall. This relationship was evident in 2024 when the dollar surged in response to rising interest rates and fears of inflation under Trump's administration. As bond yields climbed and the dollar gained strength, gold lost its luster as a safe haven investment. This dynamic is important to consider when analysing the short-term outlook for gold. Bond yields and inflation concerns. Interest rates are another crucial factor affecting gold prices. When the Federal Reserve signals or implements rate hikes, it often results in a stronger US dollar and rising bond yields, both of which are negative for gold. The potential for further Fed rate hikes, coupled with inflation fears, means gold could face ongoing pressure. However, the long-term outlook for gold remains positive, especially considering global uncertainties. The role of central banks in gold demand. Despite fluctuations in gold prices, central bank purchases have played a crucial role in supporting the price of gold. In fact, central banks around the world, particularly in emerging markets, continue to increase their gold reserves. In 2024, central bank purchases were up, with nations like China and India adding substantial amounts to their reserves. This growing demand from central banks provides a floor for gold prices and suggests that gold's role as a store of value is unlikely to diminish. Gold and other precious metals. The broader commodity impact. The strength of the US dollar and rising bond yields not only affect gold, but also impact other precious metals such as silver, platinum, and copper. In 2024, all of these metals saw sharp declines, mirroring gold's downward trajectory. This broader commodity impact is a reminder that gold is part of a larger ecosystem influenced by global financial conditions, investor sentiment, and economic factors. Gold's long-term potential. Despite the recent drop in prices, the long-term outlook for gold remains bullish. Analysts suggest that gold could reach $3,000 per ounce by 2025, driven by ongoing geopolitical tensions, central bank purchases, and inflationary pressures. The demand for gold as a hedge against fiscal risk and geopolitical uncertainty will likely continue to support its price, even in the face of short-term volatility. Gold versus cryptocurrencies. A comparative analysis. While gold has a long history as a store of value, cryptocurrencies like Bitcoin have emerged as a modern alternative. However, the differences between these two assets are stark. Gold has diverse demand. Beyond investment, it is used in jewelry, electronics, and as a store of value by central banks. Cryptocurrencies, on the other hand, are primarily speculative assets with a volatile price history. Gold's broad ownership and global production make it more resilient than cryptocurrencies, whose ownership is concentrated among a small number of entities. Gold's ability to retain value during times of economic crisis is one of its strongest attributes, whereas cryptocurrencies have experienced significant drops in value, even when traditional markets are under stress. Gold demand trends, a record-breaking surge. In the third quarter of 2024, global gold demand hit a record high of over $100 billion, driven by a surge in investment demand, particularly through gold ETFs. This increase was a response to the rising prices of gold and concerns over inflation and geopolitical risks. Despite a slight decline in jewelry demand, The technology sector saw a 7% year-on-year increase in gold consumption, driven by the expanding electronics market, especially with the boom in artificial intelligence. The outlook for central bank reserves. Central banks continue to view gold as a vital asset in diversifying their reserves. According to the 2024 Central Bank's Gold Reserve Survey, 81% of central bank respondents expect to increase their gold holdings in the next 12 months. This continued demand from central banks is a key factor in gold's price stability, as these institutions seek to hedge against economic and geopolitical uncertainties. Conclusion: gold's enduring value. Gold remains a fundamentally strong asset, valued not just for its ability to perform during periods of crisis, but also for its versatility and widespread demand. Whether in the form of investment, jewellery, or technology, gold continues to be a valuable resource that has withstood the test of time. While elections and political tensions can drive short-term price fluctuations, gold's long-term value as a safe haven asset and store of wealth remains intact. One thing remains clear: gold will continue to play a crucial role in the global financial system,